Hello, ladies and gentlemen, and welcome to the Multi-Asset Investor Stocks and Bonds in 2024. So what I'm going to do is going to review 2023, have a look at the soda portfolio, the whiskey portfolio, a bit of the outlook for next year, take questions that have been sent in to me already, which I've got some answers and some slides around those, and then finally any questions towards the end. Now, the really bad news, ladies and gentlemen, is that we have got something like what is it, 57 slides. So I'm going to have to push on. But thank you very much for taking the time today to sign up to the webinar. So this is an environment where we're talking about investments and outlooks. So please don't consider this to be investment advice. That is something that we must stress. That happens inside the multi-asset letter. So this is very much for your information only. Okay, so we're going to review the last few years. I've been doing this for far too long. 2016, I took on the whiskey and soda portfolios, or I created the whiskey and portfolios at South Bank under the Fleet Street letter. And here we are, the multi-asset investor at ByteTree, the company I founded a couple of years ago. So in all those years, we're just about to round off the 8th year, and the soda portfolios had a bit of a late surge. Having been weaker mid-year, it's now down 0.1 for the year against a benchmark that's much higher. The FTSE Atkins is up 8.3. So it actually hasn't done very well this year, but last year did extremely well. And so we've kind of been flat for 2 years whilst the market went down, making us look good. Then it went up again, making us look not so good. And the end result is annualized 99.9% return, which is 9.3% per year compared to 7.3 for the index, with a volatility of 6.1% against 6.8 for the index. So slightly higher return, 2% higher return, with a slightly lower volatility. And there's a Sharpe ratio where you basically divide one by the other. Simple Sharpe, not exactly a true Sharpe. And then the whiskey portfolio, it looks like we're up 154.9% over the 8-year period. So that's 14.1% this year, a nice little surge, including a good result from Harbour Energy today, where we can get to that later perhaps. The FTSE 100 up 6%, including dividends this year, which is an 8.1% outperformance. So, basically more than double the FTSE over the period, and again with less risk. So we've done 12.7% per year against 6.7 for the market. And we're 2.5 percentage points lower on the volatility. And I was asked earlier, what's the max drawdown of the two portfolios? Well, over the pandemic, during the scary bit in March, soda was down 10, peak to trough, and whiskey was down 11. So those are our max drawdowns over the period. Starting to look like a pretty good record, all in all. So a little review of what we saw in 2024. The bond market crash was obviously the theme of the last couple of years, and it carried on crashing until literally a few weeks ago, when it started to turn, and we started to recognize that maybe the fight against inflation is won. Maybe not. The long bond fallen a lot. On the 10-year, that's in red. The black is the 10-year bond, or the gilt in this case, and it fell from basically 99. Meaning that if you buy this hypothetical bond that I'm using, the zeros, which I sometimes publish, and so basically meant that a couple of years ago you were paying sort of 99 or 98 for a 10-year bond that was going to mature at 100 with no income on this basis. So crazy high prices for bonds, and back to some kind of reality. Today for the black 10-year, you're basically paying 70 to get 100 in 10 years time. So we're starting to see a bounce, and the markets have really quite enjoyed that. On the stock market, we've got a bunch of indices for the year in GBP. This is capital return, not including dividends. And the top line is Latin America, which may surprise people. The second line is the United States, the S&P 500. Now, of course, the S&P 500 did very well, but not quite so well in sterling because the pound went up. But the Nasdaq was obviously much higher than Latin America, and the S&P 500 without the big stocks looked pretty much like the FTSE. So we've got Europe in the middle, along with Japan. Lots of people have been telling everyone, telling me how amazing Japan has been, but really it's been the same as the FTSE. Once you've taken off the currency, or the euro stocks rather, it hasn't done much because the currency went down, which we'll get to. And then finally, at the bottom, we've got emerging markets and Asia, and that's really weakness in China. On the sector side, looking at US sectors for simplicity, but basically those top two, one is tech and the other one is consumer discretionary, which means Amazon, which means tech. So tech did very well and everything else didn't. Very simple. And the dollar, this is probably one of the most important things. You know, we had in October 2022, so about 15 months ago, we had that spike in the dollar. That was a very painful process where it went from 90 up past 100 to that point. That put downward pressure on markets, and now it's going down. That's why markets tend to be a lot more buoyant. And so you kind of seen this outperformance of the S&P 500 ever since the credit crisis in 2000, the aftermath of that in 2008, because the dollar's been outperforming other currencies, and that sort of reflects capital going to America more so than the rest of the world. Let's not forget that between 2001 and 2008, the US massively underperformed the world index. And I've been predicting that this is going to happen again for some time now. And I'm sure we will see it at some point. But this is when the emerging markets can be very, very exciting places to be, and Europe not as bad as you'd think. So, so I do think we're going to see good times for the rest of the world over the coming years. And let's not forget last year as well, what we had a banking crisis. I mean, the banking crisis that no one noticed. You know, Credit Suisse, we lost this great bank that's very old and global and big and fancy, taken over by UBS. And we also saw the death of Silicon Valley Bank and some other regional banks in the US and some crypto-related banks, really regulatory. But it really proved to be nothing because the Fed basically backstopped all bank deposits. And that's quite a strange thing. It was a huge, big deal. They didn't even do that in the credit crisis. And so, you know, when we sort of talk about a year where we've got interest rates that have gone up, quantitative tightening where they've taken, you know, the bonds that are the opposite of QE, where they've reduced the size of the balance sheet, you know, these things really haven't been enough to compensate for the fact that they've just had other forms of liquidity programs, including big state spending programs, from the government spending programs with record deficits. So it's a strange old thing, but the banking crisis that you know is the sort of dog that didn't bark. Okay, let's review the soda portfolio. Where I've got a few slides on that, and then we'll get to whiskey. So here's the long-term track record, starting to look reasonably respectable. You know, you probably noticed long-term readers of the letter would know that, you know, I don't really try in the soda portfolio to shoot the lights out. I just try and do the right thing and follow the value and manage the risk. And that worked out pretty well in the pandemic, where our drawdown was materially lower than the market, and then we started to pull away. It just demonstrates how important it is not to have big drawdowns in portfolio management, because it's much easier to get going again if you have lower losses. You know, the old adage, if you have £100 and it becomes £50, you have to double it to get back, and it's really hard to double your money. So try not to lose, you know, too much, and then it's much easier to carry on the upward journey. But there has been unquestionably a downward period in soda this year, and I think it was just it was a number of things which I'll get to. A little bit of attrition. It was not one big you know, ugly sinner. It was a number of small things which added up to I think we were down 6% at one point, which is pretty disappointing, given that you know, I consider the portfolio to be pretty robust. But it was a year, with hindsight, that you would have owned 20% Nasdaq and 80% cash, and it was as simple as that. Everything else, you know, at some point proved smelly. Capital gearing trust. Now, it hasn't actually been that bad. I think I wrote on Tuesday it was down. It caused a negative contribution of just under 1%, and it's actually rallied quite a lot today. But you know, they haven't done much wrong. I mean, in the past year, the net asset value shown in blue is barely down at all for the year, but the share price is, and so investors have been selling these kind of investment trusts, all of them. These investment trusts have gone from sort of premium to discount, including the Personal Assets Trust, which has sort of prided itself on holding NAV all the time. So there has been selling pressure in the investment trust sector, no doubt about it. And we really have to differentiate between NAV and price when we make decisions about whether someone's done a good or a bad job. But I just want to remind you, you know, who capital gearing are. This is the capital. This is the capital return of, as in no dividends, because my chart won't allow for them. It's quite annoying, but the charts with dividends look really ugly. So anyway, against the FTSE, let's assume that capital gearing and FTSE, their dividends weren't massively different over the years. But you just see the journey that they've managed to create by being conservative and having very low drawdowns. And it's a very, very impressive long-term track record. So I don't want you to end the year thinking ill of them. I think you want to look at your portfolio and feel comfortable and confident that CG Capital Gearing Trust is really a good thing to own in the long run. And now it's stuffed full of yield and value and real yield and all these things. It's going to do well over the next few years. I can't think of a manager better prepared for these kind of environments. They just do what is right. They just do not worry about market fashion. Now, Rafa, they are a bit more disappointing. Same kind of philosophy. And we did we had the webinars in the middle of the year, but they've gone from quite a big premium in 2022 to a pretty hefty discount for them. But both these funds, don't forget, they've got a buyback program. So they're buying cheap shares, which is accretive to you. The difference in their strategies principally is the fact that Rafa really, really wants to have a massive 1987 style crash because they've got lots of portfolio protection. And if the market crashed, then they'd look really clever. But I possibly think that they worry about market crashes too much because they do happen occasionally, but just most of the time they don't. But anyway, we are where we are, and I do think these funds are going to recover at some point in the next couple of years. And the premium to discount is behind us. That's the important point. There's also China. We started the year excited about the idea of the Chinese lockdown. They're all going to jump on the billion people and get on a plane and buy handbags around the world and this sort of thing. But it didn't happen. They did end their lockdown, but then I think the true colours of the economy, which is a mega property bubble, is really holding them back. And it could get ugly. That is what it's a chart. If you look around the markets today, you don't find many stock markets that look like that with the 200-day moving average negatively sloping and pointing down. So this is a market ready to make new lows, and this could be a real problem next year. So trouble in China, one of the things we have to watch out for, and it's the contagion. There's lots and lots of debt in China. Real interest rates is another theme of this portfolio, the solar portfolio, because inflation-linked bonds, whether they're TIPS or gilts or any others that you can find around the world, they're in the CG real return. They're in the obviously we've got the short-dated TIPS product, which I think is fantastic, TI5G, and then we've got various inflation-linked bonds inside Rafa and inside the capital gearing portfolio. So we've got quite a lot of exposure to inflation linked. And you don't own inflation linked just because you think inflation is going up and sell them just because you think it's going down. It's all about the real yield. So that's how we didn't have this stuff, nor did those funds in 2001 too, when real yields were negative. We had more gold. And now those real yields are very, very high indeed. So these bonds will do well over the next few years. It's pretty hard to time to perfection the interest rate cycle, and it's a very volatile cycle, but we are on the right side of history owning these things. This is my good old gold model. Served me well until about 2 years ago when gold decided to take a different path. I want to make clear that the fair value of gold, this is based on the idea that it tracks CPI over the long term, and then the funny maths in there, which relates to inflation-linked bonds, really is just trying to capture the medium-term ups and downs. And the medium-term ups and downs have not changed. Over the last year, whilst it looks pretty clear to me that this model, tips have collapsed. The black line is basically 20-year tips have gone down. So we bought them when they were low in November last year. And they started to go up again, which is good. But it's very interesting that the price of gold didn't follow tips down. And if we zoom in over the last 5 years and see exactly what happened, that horizontal line is basically the invasion of Ukraine. And that was the day when, within days of that event, the Western governments seized the Chinese treasury bills. And so emerging market central banks decided they would turn back to gold. They've been off it since 1971 or so. And there was no question that gold was the right choice going forward. And notice how the gold discount, the gold was cheap at the end of 2021, and it started to tighten that discount to go to flat. just before the war. So there was some good inside information going on between the central banks that the world was getting scarier. And that just carried on. So, gold did follow the model, but it fell less than it should have done according to tip prices, and just prove resilient. And I think that what's going to happen now, because we're at the end of the rate cycle, and whether we get cuts in early next year or not, it's pretty obvious that the key, the big tightening for now is behind us. So I think this is a long-term real recalibration of gold, and it's put on something like 30% structurally as it's become more relevant to the world. And so we'll have to figure out how to fine tune some of my valuation models on these things, but it's going to be interesting next year and beyond. Then we've got the yen. I saw this as a very good opportunity to have portfolio insurance, good entry point in 2022 when the yen was very, very cheap. But a couple of things have gone wrong here. One is that the pound went up. So, yes, the dollar-yen spread sort of worked logically, but then the pound went up, which was a bit of a sidewinder. So that was slightly unfortunate for this trade. Obviously, the pound going up is good for our country, but assuming you're British listening to this. Not everyone is. But I think that, we know why the yen's doing what it's doing. And it's because the US bond yield went up a lot and the Japanese bond yield did not. So the spread between them basically accounts for 90% of the difference in the currency. But what we have here is a ridiculously undervalued currency. It's 48% below fair value, according to purchasing power parity. I have high confidence that those two lines, red and black, will be reunited at some point, and more likely to happen at a period of market stress or a policy change. Now, the Japanese Bank of Japan have been erring towards policy change, but keep failing to do it. But in any event, this chart looks like it's turning around, and GBP yen is trading below 180 for the first time in a few weeks. So that's encouraging. I think this is really going to work next year. So a lot of things that haven't worked this year, we've been a bit early, will work sooner or later, because logic and value and financial theory will all be on our side. We're not doing anything dumb here. We're just buying value and seeking protection. So now I move on to the Whisky portfolio. Yeah, first things first, we've got the long-term track record, very similar to soda. Pre-2020, we were basically having the same returns as the market for 2.5 points less of risk. That worked out in 2020, 11% drawdown. I think the market was 35. I think FTSE 100 was 35 down at that point, and we came straight out of the blocks and have just carried on. And we've got a couple of things spectacularly right, like the momentum crashes, waving goodbye to tech at the end of 2020 or in September 2020 it was, and then positioning in the value, and we had plenty of oil and some of the commodities. We've just done some good things. And then in 2022 we had British Aerospace, or BAE Systems they call themselves, and that sort of thing. And I think just by being confident to go and buy bottom up good stocks has been paramount. What's also been interesting this year has been that I really started to run out of ideas in UK stocks. You could see the liquidity drying up, and so when we bought Rank Group at the end of in sort of October, November 22, the issue was there just wasn't enough liquidity, and the price moved on the recommendation. So I thought I've really got to have more liquid stocks, and so the move to embrace global stocks in certain places, mainly developed markets, was something I think has really paid off, and will continue to do that. And I hope that you've all felt confident about them. Owning stocks in Germany and Italy and this sort of thing, in Spain is, it's fun. It's a good thing to do. If we can find a wider net, there are more good ideas that we can spot from time to time, particularly someone like me, who's very, very quantitative in their way of finding opportunities. There's another thing that's going on in the portfolio. We do definitely have an oil bias, and it hasn't hurt us at all. I mean, Harbour Energy, as I said today, they've announced a merger today, and the price is up, 25% or something. And it's just a dirt cheap company. Lots of these things are just cheap, and oil has been coming back. And I think that the oil to gold ratio is very interesting right now, because back in 2008, before the crisis, you got about $6, 6 barrels of oil for an ounce of gold, and now you get 25 for an ounce of gold. And the super spike you see there in 2020 is because the world's transport system shut down. So that's an unrealistic situation. So I actually think that where we are today at 25 is actually pretty cheap oil against gold. Now gold's going up, so that means oil's going to be dragged with it somehow or other. So I think that gold's pretty interesting. Sorry, oil's a pretty interesting contrarian trade right now, and if we could sort of exploit the value there, or hang around the sort of infrastructure, oil infrastructure spend, then I think that that's pretty interesting. So those are the sort of stocks that I quite like. We've got the pipes and that sort of thing. Then we've also identified some momentum crashes, and to remind you what a momentum crash is this idea that the stocks that have already done well continue to do well. Now, don't get too wrapped up with the big tech here, because that's a slightly different thing. Because a momentum stock basket could be a couple of hundred companies. It doesn't have to be 7. It can be lots. And so if you make this habit of picking winners and they keep going up, then that's good. Now, what's happened is I picked up momentum crash in 2020 and we got that right, and then another one more recently, which I called last October, and then so there's another leg coming just now, and that's all playing out beautifully. And it's one of those funny things that no one really talks about any of this stuff, but I just find it so important. You invest in the winners, you're on the blue line, and if you invest on the losers, you're on the red line. Slightly different methodologies are out there. This is the Morgan Stanley data, I've got the JP Morgan data and the Dow Jones, and they're not quite the same because it's quite ambiguous in some areas. But the big ideas, like in 2008, where momentum was working very, very well in the run up to the banking crisis. And that payback, if you were invested in momentum between 8 and 9, it was absolutely brutal. And then if you look at 99, 2000, 2001, you had this very choppy market of the momentum effect during the dot-com crash. But then, post 2010, pretty stable, momentum works for a long period of time, and now it's not working. And it's reversing, and I think that does tend to favor the active value manager wherever in a momentum crash. Now, it won't last forever. At some point the market will stabilize, but there are so many distortions at the moment, and you've seen gold against tips. That's one of them. There's small cap, large cap, which we'll get to. There's sort of America versus the rest of the world. There's the big stocks. There are so many of these things that just don't quite stack up of what you call normal. And I think this is quite an important thing to keep an eye on. Zooming in, I think I posted this chart a couple of weeks ago, and it just shows you, up close and personal, that the red line is where you want to be at the moment. That's all the stuff that hasn't done well: the contrarian investor, the value investor, and the person chasing, the investor chasing trend is not going to do very well at the moment. Stock selection in Whisky. This is just to sort of recap. I don't really talk about this much, and I sort of thought, well, I never really tell people how I do what I do. So I thought, we'd take this opportunity, because it's Christmas, to spill the beans. So, the first thing that we're doing is identifying a universe of stocks, and so I've got the big stocks in Britain, America, Europe, big tech, Australia, and Canada. So basically, the developed markets. I do actually keep an eye on the Japanese top 100. But I sort of don't plan to make a recommendation at the moment of an individual Japanese stock, but perhaps we could. They're sort of tricky to trade, really, from London, but never say never. And then we looked at the fundamentals. Now, I'm very big on screening and using tech and and that sort of thing to go and identify situations. So I'm looking for value. I'm looking for a decent balance sheet. I'm looking for cash flow generally. Unless it's a turnaround, any of these are negotiable depending on the situation. I'm looking for companies that are profitable. I do like some sort of growth or an outlook for improved growth. I would look at the shareholder register, see who owns it. There's some interesting people out there who, if they're on the list, then that gives you some confidence that their analysts have come out of the research process positive. I like to see what the insiders are doing. So that's the company officers. Are they buying their own stock or not? Obviously, if they're all selling, then that's something to worry about. You keep seeing that in some of the US tech stocks. Just sort of heavy, continuous selling pressure. But at the moment, the market can wear it. What the analysts are saying, where their price forecasts are, and the share count. Is the company issuing shares, or is it buying buying shares back. Obviously, the latter's better for the share price. Technicals are important: price relative, and currency adjusted price relative. So that's how a share is doing relative to the market. Once you've taken currency into account, we're looking for winners, even if it's short-term winners. And I'm much more interested in stuff that's come down a long way, built some kind of base, particularly in this market. I'm not trend following. I'm not chasing trend in this market. It's stuff that's not cheap enough, and there's just not enough growth in the system. Volatility is something that I take very seriously. When you kind of, if you've got two similar situations, you want to choose one, the one with low volatility would always win. And then liquidity. It's very, very important in this market. If things go wrong, the ability to trade is important. And I think that, with the recent soda trades, with those closed-ended funds, we went to a 3% position when I normally I'd do a 5% position. And the reason for that was quite simply, I couldn't get my head around the situations. None of them were perfect. There was always some sort of criticism here and there, but they were also cheap. And so I said, okay, well, if we have 5 or 6 of these things, which are trading on big discounts and they're 3% weights rather than 5, not a problem. And I have had a question in on Pershing Square, which I'll come to later. And then on the macro side, does what we're doing fit in with the money map? You'll have noticed that I've been buying quality in the last few weeks. So the most recent things, because the bond market kind of looks like it wants to turn. Doesn't mean the value is going to do badly necessarily, but I've been looking for cheap quality, and we've got a couple of medical stocks and our old friend that we buy our Biros at the airport. So how are we doing? The time? We are 26 minutes in, and I've done 26 slides. That's amazing. So we're way ahead. We're cooking on gas. So outlook for 2024. The good old money map, we're basically going to move from the grey box, and the market's kind of toying with the idea of the blue box, but I think it's a bit early to suggest that there's going to be a big sea change. I think we're going to see chop in the bond markets, and so it's probably a better time to start worrying about being diversified and having a bit of an exposure in all the boxes. Obviously, that we've got high real yields now, so the gold box has got something to look forward to. So if those real yields come down, that's going to be positive for golden tips, but probably less so for growth stocks. So I'm still not interested in growth stocks. So I think our portfolio, the theme of it will be the sort of value in Bitcoin, golden tips, and quality in bonds. And by the way, I'm not going to talk about Bitcoin today because I did a webinar last Thursday. It's on our ByteTree channel if you want to see it. We did gold, Bitcoin. Inverted yield curve. So in the last few sessions, we've seen this sort of bond yield come straight down, which is basically telling the market that we're expecting 3 interest rate cuts in the United States in the Q1 next year. The danger here is that if we don't get them, then all the fun we've had in the last month in markets with this sort of Santa rally could come unstuck. So that's not necessarily a good thing. The market does seem to be ahead of itself. Where is our recession? And as I said earlier, so many reasons why the economy has held up a little bit better than expected, and markets way better than you would expect them to have done, given the circumstances. But the yield curve is very much inverted. 1.5% spread between the 3-month government bond yield and the 10-year government yield, which is very high, higher than .com, higher than pre 2008, and commensurate with the 1980-82 era. But don't forget, 1.5% gap when your yields were very high back then ain't the same as a 1.5% gap today. So this really is right to call these kind of record differences. It's telling us something's not right. So this is the other chart that I've been wheeling out, but I haven't pulled it out for a few weeks now. But it's basically equities against bonds, S&P 500 in black, and my zero coupon bond in green. It's a high duration bond, a 30-year zero coupon bond, and they just they moved together for years. And the big divergence that came, and the expectation was, if you're going to see bond yields go down that much, it's probably not going to be great for the stock market. But it really doesn't seem to do anything. And the damage to the stock market has been much lower than you'd expect. And you can explain a lot of that gap by 7 stocks, 7 big tech stocks, which we'll get to. But the difference between them is shown in the red line. So when it's going up, stocks are beating bonds. When it's going down, bonds and stocks are beating stocks. We had a big deviation in '87. We had a big deviation in 2000, and the recent one has just been off the scale. So how does it stack up? Well, going back to 1962, I think we've got here, and I've rebased those two charts on log scale. So basically, the bond yield in 1962 was about the same as it is today, because that line's 100. We do not take dividends into account on this particular chart because it's not the point of the exercise. We're trying to understand what's the behavior between equities and bonds. Equity is obviously much better over the long run than bonds. I think we'd all expect that. The lower chart in red. So the previous one we started in 1980, and the stock market and the bond market have been trading in a sort of range for the last 40 years until recently when the stocks broke out. And the other time that we saw that was in the 60s and 70s, an era of inflation. So, inflation is not good for stocks, but it's better for stocks than it is for bonds. Bonds really hate it. So I am wary about this idea of piling into bonds, because the Fed are going to cut rates and we're going to go back to, it's 2019 all over again. I'm not sure I buy that. And we'll look at some of the reasons why in a moment. Or is it now? No, before we get there, I beg your pardon, we've got a couple of valuation slides on the stock market. So this one's global market cap to GDP, and global GDP to global market cap. And so GDP slightly, global market cap slightly ahead of GDP. There's the average line in red. So, stocks are a little bit overvalued on this basis, but not drastically so. And by the way, less than they were in the end of 2021. So there's been a small reset, but if you wanted to have good confidence saying yes, stocks are cheap, you'd want to be well below that average line, which is not the case yet. Then we've got the same sort of idea, but this time we're comparing the global money supply to equity market cap, and it's bang in line. So in 2007, stocks were, the market cap was much higher, and I've got this inverted, but basically it means that the market cap was lower. Sorry, the money supply was lower than the market cap, and by the crash in 08, it went the other way around. And you've got the average line again. So that really, does fit the narrative that as they print money, the stock market's kind of followed that somehow or another. Now, that's fine, but I think the argument I would make is the stock market's distorted in the sense there's just far too much money in 7 stocks and not enough in the rest of it. Very simple idea, and guess what? We're in the rest of it. Here's another chart that goes back to 1960. This is the margin debt. Basically, it's a sentiment indicator telling you how customers in their brokerage account and how levered up they are. And they were levered in 2021, as we remember, GameStop and Stop and all that sort of thing. Then they delevered, and now they're picking it up again. And that is generally a bull market signal. We saw that in 2009. We saw that after COVID. We saw that after .com. And so that's a pretty bullish chart. So I think we've got to be constructive on the overall stock market, but I think we've got to admit that there could be some radical rotation inside of it. Great time to be a value investor, bad time to be an index investor. S&P 500 concentration. In 2001, 2000, that time, we were above 65% of the S&P again as part of the world index. Remember I was saying earlier that between 2000 and 2007, US equities massively lagged the world. You're much better off in with the rest of the world. But once again, we're at 62.9%. I find it hard to believe this can go much higher than where it already is. It is a big bubble. And when I screen for stocks, I look at American stocks that are going up and their valuation, and then I find a European stock that's going up, and it's just 50% off. As simple as that. Stocks are cheaper over here than they are over there, so that's where we buy. This is sort of a bit of comedy from good old Twitter, and those are the top 7 stocks. And so they're obviously American. Now the next 4 economies in the world, I believe, are Britain or China and Japan, and then sort of Britain, France, and probably Germany. Not quite sure Italy. I'm not sure where we are at the moment, or who is number 4. But it doesn't really matter. The point is that 7 stocks are worth more than all of their stock markets. Again, pretty absurd. I'm just going to highlight 2 stocks. So this is the 2 biggest stocks in the world, Apple and Amazon. and the red line shows the PE ratio, the price to earnings of Apple shares, and the blue line shows you the revenue growth. So the revenue growth is currently on the black line, which means there is no revenue growth. Now, there was a spurt in 2021, but that's because we all went home in lockdown, and there was a surge of tech spending, and that tech spending has slowed down again. Yet the PE ratio of Microsoft, sorry, of Apple, which was very happily between the credit crisis and 2018 was around 15 times. Then recently it's gone straight up to 32. I mean, it's a very, very high rating for a company that's not growing. I think it's worth 3 billion or something. So, I expect that to lose 2 or 3 billion over the next few years. People forget that Microsoft, which I'll just come to now, fell by 75% in the dot-com crash. 75. And here we are again, a company that's growing modestly at a very, very high rating, much higher than it has been used to in recent years. And there's just, people talk about AI and stuff, but Microsoft's already huge on software. The idea that it can become materially huger because of AI, I think we're paying it forward. So whatever good news is more than in the price today. Inflation, I did say we'd get to inflation. I think this is quite an important thing to talk about, because I don't think it is over. That's the US CPI. And there are 4 sections here. We've got, okay, my picture, I keep having to move it so I can actually see the labels. Yeah, so food is in blue, and food is basically energy. Food follows energy because food's about tractors, which is diesel. So we've got oil, which is the sort of red line. Core goods, that was the bottleneck. That was the supply chain disruption in COVID with the Suez Canal and all that. Prices went up, they've come back down again. But notice how core services really haven't moved. They were much lower before the pandemic, and now they're sort of high and still high. And this is why core inflation is now above the normal inflation, because it's the bit that you can't change. So core above headline. And those are the 2 different, the cores and headlines at the top, and then the difference between them is on the lower chart. And it was just really sticky. Inflation was very, very sticky in that period in the 1970s. And it looked like it was going down in 72, 3 because there was a recession and so forth. And then it just bounced straight back. And it did it again after that as well. So three bouts of inflation at that period before it was finally contained. And then we had our era of disinflation. So I think it's wrong to assume that inflation is definitely going straight down. And if you look at measures such as trueflation, it's got it at about 3%. This is not 2, this is not 1, this is not deflation that people are talking about. And it's probably out of kilter with what the bond market's doing. On that note, this is the UK RPI index in red, and then the blue line is the 10-year expected inflation in the future. Now, the blue line obviously is quite stable because it's looking through whatever chop there is in the economic cycle, and the red line is very volatile. So it collapses in 2008 and it goes straight back up again in the recovery, and then it has the surge and the crash that we've just recently seen. So at no point did the break-evens, the blue line, the future expectations, ever really buy into the idea that inflation was 14% and was going to stay there. So it was pretty calm. And so I think it's going to be quite interesting to see where that goes, because it didn't go up that much, but it's not really coming down that much either. And so it's now saying inflation over the next 10 years is 3.5%. And I think these are understated. So this is one of the reasons why we're going to get paid even more by owning inflation-linked bonds over the long term. And on that note of bonds, it's a bit strange that everyone's so bullish. This is the Merrill Lynch, or the Bank of America Merrill Lynch Fund Managers Survey. And, most investment managers working in financial service industry globally are now really bullish on bonds. Now, the last time they were really bullish on bonds was March 2009. Now, March 2009 was a bit late mate, as they say, because the time to be bullish on bonds was probably in mid-2007, not March 2009. Bonds had risen a great deal by that point. That was the time to be interested in equities. So the very fact that so many investment managers are positioned for a bond bull market scares me. And that's another reason to stay in inflation linked rather than conventional, because at least you lock in that real yield. And of course, what would knock bonds would be a revival of inflation. So I do think the inflation into a much better position than the conventionals. It wouldn't be me if I didn't plug my Bold index, and I'm not quite sure why this is here. Just I couldn't find a better place. Oh yes, I know what I see. For the next slide, you'll see. So the Bold index, Bitcoin and gold risk weighted, and you know all about this. But it's done exceptionally well, trading at all-time high right now. But it's also predicting an increase in the money supply. So one of the things that's held back markets over the last couple of years has been that US, UK, Europe, etc., have basically been contracting and slowing down their money supply growth. But doesn't really matter who's printing for Bitcoin and gold, provided someone is, and it's China. Thank you, China. We have at the blue line at the top, plenty of new money coming around the world. So that is the G20, and so you've got the United States in there and the ECB and all the other important components. The global average, which I just showed you on the previous slide against gold, is the red dotted line in the middle, 131.79, that one on the axis, and China's at the top. So, pretty interesting that even though there has been a stall in the money supply, it does look like we've got leadership coming out. And, once again, whenever a country seems to have a problem with their economy, they print their way out of it. This has happened time and time again. So now we move on to the questions that you have sent me, and hopefully I've got some reasonable answers. Now it's slide 44 out of 57, and it's 1641. So I better push ahead. So what was my view on Brazil? Well, really, really bullish. I think the question said, yes, but commodity prices might come under pressure. Well, I hope that I explained earlier that I think, oil is cheap gold. And so if we just look at it from that point of view, then actually to be in commodities is not a bad thing. I think that I did try commodities last year and walked away because, it was obvious that the trend was down. For most commodities, but conceptually, I think the next 10 years commodities make sense, and this is just the price to sales ratio of the Brazilian index, and really we're at the bottom of the range. So that index is much happier at 1.5 or so, and so we're well below that. We've also got the real interest rates, which I think I put in a recent piece, and Brazilian real rates are something like 6%. Huge, and as they come down, that will revalue equities. So very exciting place to be for the future. And Mexico, same, but probably the macro story there is they're taking trade off China. So more exports into the United States from Mexico rather than China. What's your view on REITs? I was asked, and we sort of got this right last October when I suggested we buy REITs. And then we sold them at a small profit because it was the banking crisis. And I said, well, God, if credit goes, this is really not going to work for the property market. Now, the price to book ratio of the listed property stocks in the UK is getting pretty close to fair value. But I think it's bigger than that. I do think that there's a serious change, and there's too much office space. There's probably better sectors. And the question did actually mention hospitals and supermarkets, but I just find it hard to get bullish on property at the moment. I just don't think we've had. I think the stock market's predicted a bear market, but I don't think the real property market has been as bad as the stock market thought it would be, and that worries me because you've got things happening in China. We have got refinancing coming. I mean, people are saying, why is there no refinancing problem this time around? And it could be that 2020, 2021 was so good in markets that any financial director worth his salt would have refinanced their entire balance sheet. And so, companies in general aren't desperate yet, but presumably it will come. So I just think that it's been not enough. This is a sort of global bubble in real estate. You could argue, and the correction so far isn't much. But here are the individual UK REITs. I've ordered that by market cap. Obviously you want to buy something with a blue means low in this case, price to book ratio, so you've got some value on your side. You want a good balance sheet, and so the low numbers are again a blue. You don't want it to default. And the dividend yields, they're just on average not high. You have to go to the bottom of the list where there's no liquidity to get the decent yields. The top of the list, they're really not paying that much. It doesn't feel like, chance of a lifetime, if you ask me about UK REITs. I was also asked about Pershing Square. Now, this and many of the other kind of, if we just call them the family office stocks, they're diversified portfolios. This is technically a hedge fund, but really we can think of it as a family office stock. It's got a portfolio of quite interesting companies, but the most important thing is the huge discount to net asset value. If that thing closes from where we bought it at nearly 40%, there's a huge amount of upside to go from 43 to that blue line, and that blue line has the ability to appreciate as well. Now, the questioner also added something about he's in consumer discretionary stocks, and fair enough. But I think that Bill Ackman, the manager, has kind of identified these companies that aren't nearly as cyclical as you think. And these are in the size of, they're ordered by size of holdings. His biggest holding is a Universal Music Group. Do we listen to less music in a recession? Maybe not. Chipotle Grill, very good company, and expanding all over the world, a sort of following the McDonald's business model. People tend to go more to cheap places when the world's when the economy is a bit tough. So these are all kind of people's choices, mid-range dining and that sort of thing. And Hilton Hotel has done extraordinarily well. As taking advantage of the reopening. I think that if you look at the far right column, the default risk, his company, I don't know what his angle is on Howard Hughes, but it's a small holding. But these companies are pretty low risk. And I think that the ones with the revenue growth being a bit low is basically because of the pandemic. It's a five-year number with a pandemic in the middle. So I think they're just cheap growth stocks and much less cyclical than we think. And obviously he's a guy who really likes return on invested capital. So there's an angle here, and it's a 3% holding, and the elephant in the room is the discount that we've managed to buy these companies for, not the companies themselves. But I think you have to believe that someone like Bill Ackman is very good at his job. He's a very successful hedge fund manager. I was asked a question about Housebuilders, and I think that I know Housebuilders and UK REITs are not the same thing, but I just feel I agree with Jeremy Grantham about global house price bubble, and I just don't really believe that there's going to be a huge change. I know some of these companies, I can't remember which one it is, but have changed their business model to basically take government, to build for the social programs or something, rather than speculate on land prices. But are these stocks cheap? Well, they're basically trading at book value, and so unless you believe that the land banks are going to appreciate heavily in the near future, then no, I don't think they are. I think they're fine. They've gone down, but they're probably going to go sideways. That said, we've got Persimmon there. You can't argue with the fact that that's a pretty good chart. The £30 down to £10 and a bit of a turn, but it could easily bounce from 15 to 10 for ages before it's a good time. So do you believe there's a global house price bubble and it's going to get really ugly, or do you not? That's it. I believe there's a global house price bubble. And then Taylor Wimpey, just to remind you, going back to 1990, you got some good history on that price. It can be pretty ugly. There's the 1990s housing recession, 75% loss, and the credit crisis. It was very lucky to survive that one. This company is unlevered, but them being unlevered nowadays means that the recovery is boring. So when they had debt troubles with the balance sheet problems, and then things get better, then there's a huge appreciation of the share price. Now, because they haven't got huge debt problems, they haven't got any debt problems, they're just boring. So should we be buying these house builders? No, I don't think so. I was asked another question was, shall I switch my capital gains trust and my RICA, my Ruffer investment trust, to UK small caps? No, absolutely not, because the reason you're owning Ruffer and CGT is you want some reliable boring in the portfolio. And I hope I've made the case that these guys know what they're doing long term. We have been through the most savage bear market in living memory since the 1970s, 60s, 70s, and they come through with losing a few percent. This is not tragic, and they would never in a million years buy the the big seven tech stocks anyway. They are now cheap portfolios, full of yield and all the rest of it. And I think that, it doesn't even matter what you're suggesting we should be buying. I think we should just own some safe long-term investment vehicles like those. And indeed, RIC Capital might be coming into the list at some point, because that's trading 25% below NAV. Excellent long-term record. They've clearly got some illiquid assets, so I don't think we have to rush on that. But I'd be much rather in the solar portfolio, play that game and stay in the sort of diversified, value-orientated investments. And here, this is FTSE 100 total return, including dividends, against a small cap index. It's amazing how similar they are, with a little bit of outperformance in 2015. So yeah, I mean, of course, the capital gains trust was way ahead of this. I do think that, if you compound, if you're on a compounding machine that doesn't have big drawdowns, that works in the long term. And I would really be uncomfortable selling CGT or RUFA at the moment, because they're on big discounts. So no, I don't think that's a good idea. And this is your view on the Pru. That's a Prudential, very much an Asian company these days. I have to say, I don't really understand the Pru. I did look at it a couple of months ago, trying to understand it, but they've got rid of M&G, they've got rid of their big US arm, and they're kind of an Asian life company, I believe, these days. And I think it will become obvious, but the analysts think it's worth about 16 quid or something, and it's trading at £8. And so they clearly like it, but I refer to the Chinese stock market chart that I showed earlier, or indeed the Hang Seng Index, which I sometimes post, and it's really not a great place to be right now. So maybe this is a really good idea for the Asian recovery when that comes, which maybe next year, it may be 2025, who knows? But whenever it comes, I think that this is something we should be looking at. And if I don't recommend it and that happens, don't forget to remind me. So that's my little Clemmy. She's 5.5 now, and we have to make some tough choices next year, and it's going to be difficult. But I think that if we just stick to having lots and lots of value, then there will be some goodies that we can own. And I think in that case, we were in Norwich in a tea room or in a hotel or something, and she was having a very difficult time deciding what she wanted to eat. So at this point, we are now going to say any more questions, and I'll try and find the Q&A. I can make it work, and we haven't got any yet. So everyone have a cup of tea or something, and then we'll dream up some questions. But yeah, it's been a tough year, and but I sort of feel that by following the principles and sort of ignoring all the nonsense, then that's our best chance of remaining diversified and all the rest of it. Okay, our first questions come in, so please write them now, and we've probably got 10 minutes or so that we can give to this. Have you heard or read the free book The Great Taking by David Webb? If so, I'd be interested in my glasses, in this, how this affects your approach of wealth preservation. No, but I think is it a book on absolute return and drawdowns and the compounding maths and that kind of thing? I'm afraid I haven't, but perhaps you could send me a link or something, and I shall look at it. But yeah, thank you for that question. And I'm going to wait here for 20 seconds, and if something comes in, I'll answer it. Otherwise, we will move to the final slide. Do you think that all that cash parked in money market funds will rotate out into equities in 24? If so, where do you think it will go? That's a really good question. I mean, I think there's just so much money in the world, and this is really what's changed everything. It's become about measuring and understanding liquidity. It's kind of just become more important than fundamentals. Fundamentals always win in the end, yeah. But when you just got this tsunami of money, it conveniently just charges into the biggest, most liquid stocks. I think that's going to reverse, and I think it's the rest of the world that's going to win. So I think we are going to be looking to do things in emerging markets. I think we're in the right place with Latin America. I think Pakistan could be interesting. I know it's got politics that are that are questionable, but we're not buying the government. We're not buying the government. We're buying the private companies. I think that's a very important point to make. Argentina might be interesting. There's no investment vehicle we could buy in the United Kingdom. There's one in America, but that's quite annoying that we don't have one there. I think oil could have a comeback. I really don't think that even if we have a recession in the West, that global demand will shrink massively. So, yeah, I mean, the sort of things I've been saying, emerging markets, single stocks. I think stock markets don't necessarily go up. They might go down a bit. I mean, who knows? But basically, I think the rotation within to the value is going to be really, really important. And when I look at our portfolio, when I look at Whisky, I just think it's a tech portfolio. The companies that, apart from WH Smith that sells books, I mean, most of those companies are doing something pretty high tech. They're just not judged by the market to be doing that. If it's not Silicon Valley, it's not code orientated, it doesn't get the rating these days. But I think it's I really look at those companies that we own with admiration. Do I think the money market money is going to go to? Who knows? Who knows? But the money market money will stay in money market funds whilst interest rates are attractive. I would think that's probably my best answer there. Any thoughts on the 18-year real estate cycle? No idea. Never heard of it. Is that the? I know the chat you're talking about. Used to be at South Bank. I don't know anything about that. But yeah, 25, 26. Why not? So we sort of hang around for a bit, pretend to recover, but then that's when we get the real problems. Yeah, that could happen. Akil Patel, isn't it? That's it. No, I have not read his work on that, I'm afraid. What is your price prediction for BTC at the end of next year? I think gold wins on a risk-adjusted basis. So that means that if you're quarter Bitcoin and 3/4 gold, then if gold does 20, Bitcoin's got to do 80 basically to be a fair fight. I think gold's going to win next year. I think it's going to outperform Bitcoin on a risk-adjusted basis. But that's just my fun year-end punt. In truth, I don't really care because the bold strategy is designed so you don't have to care. It's about owning both and rebalancing and that sort of thing. If the money supply picks up, then both assets will probably do fine next year. Of course, there is halving, which is good. There's the ETFs probably going to get the green light from America. Hopefully, that will follow to the UK. So that will all be good. The world markets will buy Bitcoin, and I hope that turns into a decent long-term bull market. I kind of think that Bitcoin success is inevitable. Is the world more digital in 10 years' time or less? The answer has to be more. So therefore, this sort of thing is going to continue to thrive. Thank you for your question, Richard. John says, what's the minimum amount invested in multi-asset Whisky, and what are the top 3 stocks to buy initially? Sorry, do you mind emailing me that and I'll answer it offline? Can we have more of these presentations? Of course you can. I've been looking for someone to have some fun with, but I've realised that I have to do it on my own. It's lonely here on the desert island. But I think it does work for me just to talk to camera. But it hasn't. It's been something that last week I found a bit strange, but I'm a bit more comfortable with it this week. So yes, I think we can do this if people would like me to do them. Thank you. What circumstances will prompt you to sell equities next year? Oh gosh, millions of things. A scary banking crisis a scary banking crisis, did make me sell equities, and it didn't turn out to be anything. So, I hope we don't get too many false sell signals because they're wasteful. When you sell something and the market doesn't go down, it just destroys your relative performance, and that's not great. But I think that you carry on anyway. If we get reasons to be worried about markets, then I think it's right to act. And if the market recovers soon after, well, that's that. It's just you can't get it right all the time. But risk always comes before reward. I think that's a very important principle of good investment. Lots of risks out there, Richard. But right now it's Christmas. And I've got the link. Thank you, Jack. And then when can ordinary investors buy Bold ETF? Well, anyone can buy Bold ETF. You just have to self-certify that you are a professional, elected professional, which you can do. It's up to you. It's your right if you want to. You don't have to, and I'm not advising anyone to do that. I think you'd be much better off to probably just wait for the rules to change, which I hope won't be very long. I mean, it does seem to be absurd that gold that's kind of, I think it's up 30% this year in GBP and 34 in dollars, with a volatility of 13 and 15 respectively. I mean, it's just extraordinary how it's working. And I didn't think it would be as good as it is. But it just basically needs markets to come to life a little bit in any direction, whether it's risk off or risk on, and gold pulls away. And it's just because there's this natural negative correlation. It keeps on happening. You very rarely see a day when Bitcoin's up a lot and gold's also up. It's normally a normal day we see Bitcoin up, gold down. And it's that ongoing process of rebalancing that's just like climbing the escalators, just constantly going up the escalators. So I have one last slide, and it says, there it is, Happy Christmas, Merry Christmas and a Happy New Year. So I'll say thank you very much to everyone who supported ByteTree, and it's been our first year, and the support's been great. So I'm very grateful to you. And I think that if you're bored over Christmas and you're talking to someone who's boring, then tell them about ByteTree. Tell them about Bold, because the more the merrier. We'd love to meet them. No one's boring to us. We love them all. So happy Christmas, and thank you so much for the year. And let's hope that we do a good job next year.